Welcome back to another video. This is the update for Tuesday, August 25th, 2020. It is 6:10 a.m. My caffeine is kicked in. Okay, so folks, this is from Zero Hedge, but previewing Powell's J-hole jawbone. Buy gold in case it all goes wrong, which is what I've been telling you. There are 3 ways to make living on Wall Street, quote, be first, be smarter, or cheat. As yet another storm batters the UK, I drove she who is Mrs. Blaine to the station early this morning. The brave little soldier is going up to her office in London today for the first time in March. I don't see what that has to do with anything. Last time I read anything from Bill Slane. The S&P hits another record high, but headlines this morning include the first documented case of reinfection with COVID-19. Some 5 months after suffering the virus, a Hong Kong chap has contracted a different strain of the virus while in Europe. Because it's never going away, folks. It's just another type of cold, another type of flu, and they are going to use this to control you if you let them. Apparently, it's nothing to worry about, as the fellow might have had very low antibody levels from the first mild infection, and the vaccines being developed shouldn't be rendered ineffective because virus mutations won't change the way it binds to cells and triggers as an immune response. Trying to cut through the noise, it sounds like COVID is going to be just like flu, right? Immunologists guessing which strain to immunize against each year. Maybe that's a good thing. The market is so priced in vaccine expectations it was increasingly looking a sell the fact moment when and if it actually ever happens. Meanwhile, good news is bad. Great news in UK as Tesco announces 16,000 new jobs for its internet delivery service, which has doubled in volume during the pandemic. That's another nail for the high street, an example of how COVID has accelerated the evolution of retail away from high streets and malls towards internet delivery. In the States, lumber prices have doubled on the back of the pandemic construction boom, holding back new buildings, pushing prices higher, eat, sleep, repeat. What you win on the swings, you lose on the roundabouts. Inflation averaging. And then there's this week's big event to look forward to, right? This is tomorrow, I believe. Fed Chair Jerome Powell will use the virtual Jackson's Hole conference to announce the average inflation targeting. Whoop, whoop, whoopity-doo. All the Fed watchers think this is going to be profoundly significant, a historic moment as the Fed will continue with a 2% inflation target, but instead of worrying if it goes above, it will allow inflation to remain higher for longer, i.e. averaging for the periods when it's sub-target. These are just words. Meaning is more important. What it actually means is the Fed will simply ignore inflation and won't hike interest rates if when the economy is overheating and inflation rises. The market will love it. Quote, inflation averaging means don't worry about rate hikes or normalizing rates. We are so desperate for inflation, we're going to encourage it. It's a way of reassuring the market there won't be interest rates rises forever and ever, and magics away the fear of a market taper tantrum if inflation were to rise. It completely resets the game of Fed watching. You don't have to worry about interest hikes ever again, or at least in the medium term. This confirms what we've come to understand. In the battle against deflation, the Fed, and I guess the other central banks, see markets as the major weak spot. Wow, you know what? This is the last time I'm ever going to read an article. First and last time, if I ever see this name again. Bill Slane via morningporridge.com. Dude, retire. This is the worst fucking thing I've ever written. Or read, excuse me. This is ridiculous. I'm almost like ready to give up on it. It's all over the place. Wow, where was I? Are managing markets to avoid a global market meltdown occurring, which would further drive chronic economic weakness across the whole global economy. Economically, the effects of pandering to markets are proving disastrous. Inflated asset bubbles and a massive debt anchor tied around our feet. The result is we are stuck in irons. Let me explain. In irons is a sailing term. It's a crisis which can occur when a sailing ship has to return through the wind. Yachts can't sail directly into the wind. At best, they can sail upwind at an angle, say 45 degrees, either side of the direction of the wind is coming. Sailors call sailing close to the wind close-hauled. It's when the boat leans over at a frightened angle. Because you can't sail directly into the wind, there is a 90-degree no-go zone centered on the direction the wind is coming from. If a boat has to tack through the wind and it's going too slowly, doesn't have enough momentum, or something goes wrong as the maneuver is happening, the boat can get stuck in the wind, its bows pointing directly into the wind, and the sails flapping uselessly. We say the boat is in irons as in handcuffed. It's extremely difficult to get the boat back on the wind. It's happened to us over the weekend when oh my god. Dude, worst article ever. Let's see if I can skip to some of this The pandemic has simply catalyzed an economic crisis that's been brewing since 2008. Yes, we know that. We've never really truly recovered from '08. Finally, you said something useful. It's a culmination of overregulation in the wake of the 2008 crisis, a transfer of risk from banks to the asset management sector, distortions from artificially low interest rates creating massive price bubbles across the financial assets, soaring debt levels, and deflation rather than inflation becoming the major threat. It's happened at a time of enormous technical innovation, which has rather hidden the reality of a growing deflationary threat as Western economies choke on debt and companies increasingly become debt-encumbered zombies. We haven't learned much from the 30-year Japanese deflationary death spiral because we've been so excited about the potential of internet shopping, the connected economy and smartphones, soaring property values, and the consumption-led economy. Now that economy is wobbling and increasingly unbalanced, it feels like large parts of the global economy are flapping uselessly in the wind. Getting the economy back on track after the sudden turn forced upon us by the pandemic is proving much tougher than central banks expected. They know that QE failed to stimulate growth by much after 2008 quantitative easing, but it did avoid a succession of embarrassing market collapses by bailing out banks. We should have not bailed them out. The newest buzz expression in markets is a K-shaped recovery, explaining why the big five tech stocks have done so. The big five tech stocks have done so extraordinarily well, while the rest of the market are laggards. The real pain is still yet to come. Banks are simply not lending at present, concerned about their rising NPLs while keeping capital ratios high so they don't upset shareholders or trigger co-capital instruments, which governments might just do anyway. That means SMEs too small to feast at the burgeoning new issue debt markets are likely to find themselves starved of a new capital as this recession really bites. It's therefore likely the underperformance between the tech haves and the SME have-nots is going to accelerate. The right strategy is to keep arbitraging in the increasingly convoluted mess the central banks have created and are walking us all into. The central banks are trapped in promises to do whatever it takes and low interest rates forever. What inflation does, the problem for investors is where to find returns, the only answer to take on more and more risk with lower and lower returns. And finally, buy gold when it all inevitably goes wrong. You should be buying gold, folks. You definitely should. I'm just going to see if anyone else shares the opinion that I do about this guy's writing style. Yeah, buy ammo because it is all about to go wrong. Just remember when the war starts in earnest, bankers are the real enemy. 10 points for headshots, folks. That's funny. I really do hate this guy's writing style, though. Thanks, Bill Slane. I think that'll be the first and last article I read from you. Kind of on the same topic, Powell's coming inflation speech may weigh over dollar and boost Bitcoin. This is from CoinDesk. U.S. Federal Reserve Chair Jerome Powell is expected to bolster expectations of inflation during his keynote speech at the Jackson Hole Economic Policy Symposium on Thursday. According to analysts speaking to CoinDesk, that could ultimately lead to further drops in the dollar and greater buying power for Bitcoin traders and investors. The Fed chief is expected to signal tolerance for higher inflation during the speech, with the central bank having mostly missed its 2% inflation target since 2012. Powell has previously stated that he doesn't think inflation is a significant risk and is prepared to see it overshoot to meet his objectives. Probably because he's a deflationista. He's probably way more worried about deflation. A more relaxed approach to managing price measures could power a stronger rise in long-term inflation in the U.S. The major impact for the crypto out of this symposium would be a change in monetary policy and further depreciation of the U.S. dollar, which could propel Bitcoin higher. Inflation is expected by many in the cryptocurrency space to be a driving factor for Bitcoin gains. Agreed. Yep, as perceived to be a hedge asset similar to gold. Absolutely. It's not something they can just print. As the dollar gets weaker and weaker and you get less buying power, you're just losing money. The symposium, attended by central bankers, Fed Reserve members, economists, financial organizations, will be held virtually. Okay. The 10-year break-even rate, which gauges market expectations of inflation, has risen to pre-coronavirus levels above 1.6 from a low of 0.5 observed during the market's crash in March. Bitcoin has largely tracked the metric higher over the past 5 months, while the dollar index has declined by 10%. The cryptocurrency has witnessed greater year-to-date gains in US dollar terms to compare to those seen against other cryptocurrencies like the euro and the yen. The data suggests that Bitcoin's recent rally has been to some extent fueled by the diminishing value of the dollar. Yeah, it's interesting. I don't know. I mean, I suppose it has. And then what about the halving? We had a halving earlier this year. It happens like every 4 to 8 years. While the rally appears to be on pause right now, Bitcoin looks well positioned to benefit from a resurgence in inflation and further devaluation of the dollar over the long term. For sure, I would not let the cryptocurrency prices of the last few days make anyone bearish. I am still incredibly bullish on crypto, as long as we can maintain our infrastructure. At press time, Bitcoin is trading near 11,550, representing a 1.8 drop on the day. Multiple rejections above 12,000 seen over the past 3 weeks have put brakes on the rally from July lows below 9,000. A deeper pullback may be seen if the immediate support at 11,000 is breached, according to analysts. Okay, I'm still bullish. And related news again. The current pause in Bitcoin is not bearish, according to Jim Wyckoff. This is from Kitco. Bitcoin US dollar prices are a bit weaker Tuesday. The market has paused recently amid choppy trading, which is not bearish. Bulls still have the solid overall near-term technical advantage. A 5-week-old price uptrend remains in place on the daily chart. Stay tuned. Okay, nice ad, by the way. Yeah, I mean, that's exactly what I've been saying. Not much to say there. And let's check out gold prices. The market's open. Gold is trading a little weaker today, but still above 1900, sitting at 1920s. Silver is up. Okay? How do I always end these videos, folks? What is the thing I always tell you? I'm going to tell you every day. Silver eagles, silver eagles, silver eagles. That is the easiest way to get into silver. They still mint these, okay? They literally, the Treasury still makes these all the time. They issue them every year, just like they do actual coins. They are worth $26 a piece. You're probably going to pay about $30 or $29 for each, and you will be very glad you did. Lynette Zhang thinks the real price of silver is $600 an ounce. Okay? She thinks the real price of gold is $11,000 an ounce. Just something to think about. Cryptocurrency markets are kind of stagnated. Everything's in the red with the exception of, well, Tether. You know why Tether goes up is because people are cashing into it. I don't know why Bitcoin SB would even be still a thing, but there it is, 0.3%. Cosmos, which I know nothing about, is up 10%. Another stable coin is up a little bit. Huobi token, don't know anything about it. Aave is a new DeFi coin as far as I know, up 20%. The rest is kind of just where it is. You're not going to see me ever shilling for one of these brand new coins. I don't do that. I'm way more into the low risk cryptos, like the top 5, the top 10s. My risky crypto is VeChain, and another one is DJB, Digibyte, for example. But you're not going to catch me ever promoting something that just doesn't belong in the top 10. Anyway, that's a good short update for you today. Buy gold, hedge your bets. We have a big event from Jay Powell tomorrow. See what he says about inflation and where the dollar's going. And with that, have a great day.